Hello, I'm Bahl Gaynor, co-founder of Bahl Gaynor some 25 years ago. During periods of market stress, we feel it's important to answer our clients' concerns. With me today are Jeff Bahl, our fixed income analyst and banking analyst, and Jim Russell, who runs our high quality global dividend growth fund. Jeff, the phrase credit contagion is something we have not discussed often since the financial crisis. What are your views on what is happening to credit?
Credit's kind of a funny thing, Veer. It doesn't matter until it matters, and when it matters, it's the only thing that matters. From 2010 to 2015, we saw a massive releveraging of corporate America. Corporations were encouraged by activists and their own shareholders to add leverage via buybacks or ill-fated M&A. The repercussions from those decisions we're seeing right now. There's been a wave of corporate defaults and dividend cuts from undercapitalized companies. We view that right now credit matters, and to be an equity investor and not know your balance sheets, you're really fighting with one arm behind your back. The companies that we're really looking for are the best capitalized and the ability to access capital markets through any cycle, because at this point it's very clear that access to capital is not a given, and corporations that had capital structures that were dependent on constant access to capital are finding it very hard to sustain their business models.
How can that credit view impact stock selection at Bahl Gaynor?
I think a really good way to look at it is the energy sector. The energy sector is very cyclical with margins that are unstable. If you were to look at that business model, you would say that is a business model which probably should have not a lot of leverage and low and sustainable dividends. However, there were many companies that had high capital expenditures, high volatility margins, and high dividends. In hindsight, those dividends were unsustainable. There have been a few notable dividend cuts in the last few months, and in our view, industries that look like that and have those characteristics are not great long-term investments for income-oriented investors. What we're focusing on here in Bahl Gaynor is the ability to pay dividends and grow dividends through any economic cycle.
Jim, from your global lens, can you comment on what you think are the biggest headwinds?
You know, Veer, we see a lack of global demand right now to be the biggest headwind. We're taking global growth estimates for 2016 to the 3 to 3.5% range. By comparison, last year was a global growth of for 2015 of 3.1%. So clearly more of the same in terms of global economic growth. Both business spending and government spending will be under pressure all of this year. For instance, in the United States, China, Japan, the entire EU, and most emerging markets, many of those economies are already in outright recession. Many of those economies are bumping along bottom despite the fact that global central banks have done heroic things to keep interest rates on the low side of any historical range. Clearly, oil and commodity prices are a key headwind. Many companies and many countries are completely reliant upon revenue sources from the commodity and oil complex. Those budgets are under pressure. Just ask Venezuela, Russia, Brazil, and many of the emerging markets. Those are coming in under budget. In the good old USA, the energy sector is completely attributable for 1/3 of the entire capital spending of the S&P 500. Those pressures are also evident in the economy. $1 trillion of capital spending is unlikely to be made in 2016, or those projects are on hold. Clearly, we're under pressure from that perspective as well. Earnings estimates for 2016, 2017 for both global and domestic companies are under pressure. Clearly, we're in a profits recession, even though technically we're not in an economic recession. Things are a little bit tough this year.
Jim, where are you finding growth at a reasonable price?
Veer, it's a good question. Clearly, this is the type of environment where a rising tide will not lift all boats. It's our operating assumption that there will be more losers than winners this year, so stock selection is paramount. It's also our operating assumption that pricing power will be elusive for most companies out there. So we think that maybe major software companies that are taking market share on a global stage might make some sense at this time. We also like global financial players that can operate well in a slow global growth environment, have solid credit profile, as well as ones that have embraced technology in order to keep costs low. Third, we also like areas that in the medical and healthcare area that have also embraced technology, have patent protection, and are perhaps pursuing emerging markets during this period of global slowness to achieve both market share and regulatory hurdles. So we think those areas make sense in the environment that we foresee. Veer, in your 45 years of investing experience, have you seen periods like this before, or is this in time without precedent?
Whenever, Jim, there's signs of financial stress, it's easy to forget that high-quality common stocks represent fractional interests of excellent businesses who have the ability to grow cash flow, earnings, and dividends in various difficult environments. Inevitably, the stress will abate and the value of high-quality common stocks will reassert itself. As always, thank you for watching and for your trust in Bahl Gaynor.